tax reform. Two new polls out this morning from Gallup and Quinnipiac show dismal reviews of the GOP tax plan from the American people. Gallup found 56% of Americans disapprove of the bill, while 29% approve. Quinnipiac, meanwhile, found that similar results, showing that 53% of Americans disapprove of this bill, 29% approve. Joining us this morning is the chief investment strategist at Raymond James, Jeff Saut. And Jeff, it is good to see you. Thanks so much for joining us.
Merry Christmas.
Certainly feels like Wall Street approves of the plan.
Well, I don't know how anybody can approve or disapprove of it because you haven't seen the final form of it yet.
Okay, fair point. How important is it for this market to stay where it is?
I think it's very important to get corporate tax reform. I don't think you're going to get everything that they want, but I think you are going to get lower corporate taxes. And for every 1 point drop in the corporate tax rate, it hypothetically adds $1.31 cents in earnings to the S&P 500 earnings for 2018.
So where do you have 2018 earnings in your price target on the S&P?
Well, S&P right now, we use S&P bottom-up operating. They're about $144 for next year. So it's conceivable you could have $155 in S&P earnings, which means you're trading at 17 times, which is not that outrageous.
Right.
But to your point, and this is the business that Lee is in, the centerpiece of this tax bill and what will be the change in tax law is the reform of corporate taxes. People should be responding to that in these polls. They haven't messaged that well at all. And again, they're letting the Democrats drive this horse and buggy, because they're focused on what are you giving to the individuals. That's not what this is about. This is about making America more competitive than it is.
That's right. I think the big story here is that it's not just that half the people disapprove, because that's not what we're seeing. We're seeing a quarter of the people don't know. And it's impossible for people to get their information right now. You watch the news, you see one side of the story. People don't know where to go for information. So when I'm polling people and I'm talking to people, they say on the one hand, it sounds like it's going to be middle class tax relief. On the other hand, it sounds like it's going to be tax benefits for the wealthy. I don't know what to believe right now. So
well, you have Nancy Pelosi going, this is going to be the apocalypse.
She said Armageddon.
This is Armageddon.
Well, the Democrats have gotten very, very good at a resist movement right now. And that is one that at all costs, they will not compromise. They're not willing to have a conversation. And that's costing the American people's confidence in government. And so they might think that they're doing a great job and getting the support away from the president, but that's not what's happening.
Right. Well, Jeff, given that there's so much division, especially on what the tax plan is going to do, then where do we position ourselves next year? I mean, we've got the Fed raising rates
very slowly.
Very slow. Well, they're
unwinding a $4.5 trillion balance sheet.
Well, yeah, but
people are wondering if that's going to be disruptive.
They're predicting 3 rate hikes next year, which that could significantly impact the cost of capital.
So let's talk about the risks. That's the Fed. You've got a recovery that's been going on 8 years plus, and people are saying, look, usually recoveries do die of age. After 8 years, we usually see a return to slowdown, if not recession. You also have, you had 3% quarters, 2 in a row of GDP growth, and you have $6 trillion in market value this year. So I don't know. Does that continue into 2018 with these risks?
You know, I would argue that the downturn, this was not your father's typical recession. The downturn was so severe and the recovery so muted that normally you'd be in late cycle right now. But I think you've extended the mid-cycle, elongated the mid-cycle, and you have years to go before you ever tip over into late cycle. So, yeah, I think it can go on.
So do you think the biggest risk we have is actually we overheat the market, we start to see inflation tick up, and then the Fed comes in pretty fast, and they come in and they raise rates too high? Do you think that, because there's talks about that, right? Everybody's kind of worried now, is inflation going to tick up? I mean, the recent GDP print at 3.3% beat anybody's expectations. And so where are the biggest risks that you see in the market?
I think inflation is going to tick up, but here, too, like rates, I think it's going to tick up very, very slowly. And we're in a secular bull market, and secular bull markets last 15-plus years.
Wow.
1949 to 1966, there were pullbacks. The Jack Kennedy steel crisis of 62, where they tried to raise prices, and Kennedy said no, and the markets lost 30% in a few weeks. Then 82 to 2000, were there pullbacks? Yeah, the 87 crash, but it didn't stop the secular bull market.
Well, before the Ken Starr report came out September 11th, 1998, the S&P lost 20% in 2 months. Now, granted, from the moment that report came out till the end of the year, even during the impeachment proceedings of President Clinton, the market came back and then some, was up 25%. The bull market didn't was not interrupted until the bursting of the tech bubble. However, it's that kind of political risk. People need to be prepared for that.
Yeah, and what is the 10-year telling us right now? I mean, we've got all this good news. What is the 10-year telling us right now in terms of this inability to move?
That it's overvalued, maybe.
Yeah.
That it's just wild. Because I think that maybe next year is the year something gives. There's going to be a downturn in one of those markets, whether it's the Treasury market, if you're long Treasuries, or in the stock market.
Well, we'd be remiss.
Or both.
I mean, look at what happened at tech this week.
Yeah,
I mean,
we got to talk tech.
Tech is the leadership so far this year. It's done exceptionally well. It's led the market higher. Next year, should we look at financials, given the fact that we could get a tax break? They pay some of the highest taxes. It's a domestic story. Should we look at small caps? Where should we see? Or do we continue the tech? I mean, given the tech sell-off, is this a time to buy?
Well, you had a tech sell-off in June, if you'll recall, and it bottomed in July, and the tech indices are up like 15, 16% since then. So I don't think this is that big a deal.
Well, what about this last couple of days? What is that telling you?
Not much. I think if I had two sectors and only two sectors to play, it would be tech and financials. And I would also like to clarify, I don't think 20% down is a bear market. 50%, 60% down is a bear market.
Well, the definition of a bound market, though, is 20%.
Ned Davis,
you just don't buy it.
I don't buy it. Ned Davis came up with that back in the 70s.
If you lost 20% of your money, would you, or your account value, you don't think that's a bear market? Yeah, I'd be like, I'm a little worried about this.
Well, the big secret in this business is to avoid the big loss.
Right.
And it's not hard to do.
But nobody can time the market. So
that's not entirely true. If you listen to the message of the market, you can decide if you want to be playing hard or not playing so hard. Big difference between that and timing the market.
So you're still a buyer. You still like tech.
Yep.
And going into 2018, what does an average portfolio look like to have significant gains?
I'd be 70 to 75% long equities.
All right, Jeff, we'll leave it there. Great to see you.
Always a pleasure.
Thank you so much. Jeff Saut is from Raymond James. We will watch that.